What is EBITDA? Investors use EBITDA, earnings before interest, taxes, and amortization, as a gauge of a company's profitability. It is useful for comparing businesses in the same industry to one another. It may also offer a more realistic picture of the company's actual performance over time in some circumstances. Depreciation is another similar measure that is added to this group of variables. Before interest, taxes, depreciation, and amortization, EBITDA. Understanding EBITDA. Some analysts and investors believe that a company's EBITDA is a more accurate indicator of its true earnings. It takes out of the equation the effects of taxes owing, interest on corporate debt, and amortization, which is the accounting practice of deducting the cost of an intangible asset over a number of years. One advantage is that it makes it clearer how much cash flow a company has available to pay dividends or reinvest in the company. It is also seen as a barometer of how effectively business activities are conducted. EBITDA versus EBITDA. EBITDA, which includes depreciation in the computation, is more frequently used than EBITDA. In business accounting, depreciation is the process of documenting the declining worth of a company's tangible assets over time. It's a method of accounting for the deterioration of assets like machinery and buildings. Some businesses, like those in the manufacturing, telecommunications, and utilities sectors, need to make significant investments in infrastructure and equipment, which are reflected in their financial statements. Both EBITDA and EBITDA are helpful indicators of an organization's operating profitability. Profitability is the amount of money made during regular business operations. The official earnings total may be reduced by capital expenditures and financing charges to provide a more accurate picture of the company's profitability. Both EBITDA and EBITDA are typically regarded by analysts as trustworthy measures of a company's cash flow. Some sectors, though, necessitate a substantial investment in fixed assets. By omitting the depreciation of certain assets, using EBITDA to evaluate companies in particular industries may misrepresent a company's profitability. In that situation, it is thought that EBITDA is a better way to gauge operating profitability. In other words, for businesses without significant capital expenditures that could distort the results, EBITDA may be utilized instead of EBITDA. Calculation of EBITDA. An analyst must first ascertain the company's earnings before tax, EBITA, in order to compute a company's EBITA, EBT. The company's financial statements and other investor relations documents include this number. Any interest and amortization fees should be added to this sum. Thus, the equation is EBITA equals EBT plus interest expense plus amortization expense. Summary. The accounting process of amortizing the cost of an intangible asset over a number of years is known as amortization, and it is removed from the profits equation by EBITA, which stands for earnings before interest, taxes, and amortization. A more realistic picture of a company's actual performance over time may be obtained using this metric. Also, EBITA might make it simpler to compare different businesses operating in the same sector. Thanks for watching. Don't forget to subscribe.